When people perceive that an economic downturn is on the horizon, one of their greatest concerns is that their savings will be lost due to the collapse of a bank. Banks typically collapse because they become insolvent, which means that they do not have sufficient capital to cover all of the deposits made by their customers, as well as any money that they owe to other people. Before we get deep into it, subscribe to our channel first. Recently, there were 3 regional banks that went bankrupt. When word got out that these financial institutions were in trouble, there were runs on deposits at these institutions, as well as a variety of other regional banks. Silicon Valley Bank, SVB, and Signature Bank both went down in March 2023, and First Republic Bank was unable to keep its doors open for business by May 2023. After the failure of SVB and Signature Bank, the Federal Deposit Insurance Corporation, FDIC, took the extraordinary step of protecting deposits that were both insured and uninsured. After the failure of First Republic Bank, JPMorgan Chase purchased the majority of the failing regional bank, and as a result, all deposits at First Republic Bank were automatically transferred into accounts at Chase. Customers of federally insured banks that fail are allowed to reclaim their cash up to the insured maximum, regardless of the reasons why the bank failed, whether it was due to the state of the economy or other circumstances. In the following, we will take a more in-depth look at what transpires when a bank goes bankrupt. What takes place when a bank goes under? The Federal Deposit Insurance Corporation, FDIC, is the independent regulatory body within the United States federal government that is in charge of banking supervision. Deposits made at banks that are members of the FDIC and offer deposit accounts are eligible for insurance protection from the FDIC. The Federal Deposit Insurance Corporation, FDIC, has a standard coverage limit for deposits of up to $0.25 million per depositor, per FDIC bank, and per ownership type. This ensures that each depositor receives protection of at least $0.25 million in the event that their bank is FDIC insured. When the FDIC or a state regulatory body is responsible for closing a bank, such institution is categorized as a failed bank. As soon as this occurs, the assets of the bank are handed over to the agency, which is most frequently the FDIC, and the debts are settled. Kirk Meyer, a registered financial consultant and a former bank examiner with the FDIC, says that in most cases, the FDIC does not genuinely wish to keep and run the bank. This is according to the statements of Kirk Meyer. When an institution fails, it will generally be announced on a Friday evening, says Meyer. At that time, the regulators will take control of the institution and work to either sell it or dissolve it. Should the property be put up for sale, the purchasing organization will be disclosed and a plan for the transition will be formulated. On the other hand, if the bank were to fail, the Federal Deposit Insurance Corporation, FDIC, would be in charge of winding down the financial organization. The Federal Deposit Insurance Corporation, FDIC, will work to settle debts and claims for deposits that are greater than the insurance limit. When a bank fails, what happens to the money in customers' accounts? In the event that your bank fails to operate, the fate of your money typically hinges on whether or not it is insured. According to Jim Pendergast, Senior Vice President at Alta I&E by the Southern Bank, there is a strong likelihood that the Federal Deposit Insurance Corporation, FDIC, insures your bank. Pendergast argues, in theory, your money is safe, but he can't guarantee it. But that's a little bit like saying your house is safe during a blaze if you have fire coverage for it, the speaker continued. Going through this process does not come without its share of anxiety. If the entire amount of your deposits is greater than the FDIC coverage limit, then you have a reason for major concern in the event that the bank fails. If the total amount of your deposits is higher than the amount that is insured, then the excess amount is not protected by the insurance policy. The following is what takes place in each scenario. You can anticipate receiving a complete reimbursement with money paid from regulatory financing if the amount of your deposits at the institution is less than the maximum amount covered by the FDIC insurance policy. Not having insurance. According to Meyer, things become somewhat more complicated when dealing with sums that are greater than the coverage limit. If the ownership of the bank is changed to one that is in better financial shape, there is a good likelihood that no money will be lost. On the other hand, in the event that it isn't, you could be required to submit a claim in order to receive the additional payments. You are only eligible for repayment in the event that there is money remaining following the sale of the assets. The basic line is that if you keep your money in a bank that is insured by the Federal Deposit Insurance Corporation, FDIC, you will be guaranteed at least up to $0.25 million. You will therefore be compensated at least up to that amount, even if you have more money in the bank than that. After that, you can look into collecting the remaining items at a later time. Following the failure of the bank, the FDIC has stated that it will make every effort to return your insurance money within 2 business days. The National Credit Union Association, NCUA, which serves credit unions, offers a service that is analogous to this one. If your money is held at a credit union, it enjoys the same level of protection from the NCUA as if it were held at a bank. No matter what kind of financial institution you feel most comfortable entrusting your money to, this can provide you some measure of peace of mind. It is essential to be aware, however, that some financial institutions, including banks and credit unions, provide accounts that aren't safeguarded by the FDIC or the NCUA. If you have a brokerage account via your current financial institution, the Securities Investor Protection Corporation, SIPC, will protect the funds in that account. Your cash and stocks in your brokerage account are protected by the Stocks Investor Protection Corporation, SIPC, up to a maximum value of $0.5 million. Be sure that you are aware of which accounts are protected by which kind of insurance in the event that the company goes bankrupt. This will allow you to determine how much you are eligible to receive, as well as the source of the guarantee. What factors lead to the failure of banks? The failure of several banks during the Great Depression led to the establishment of the Federal Deposit Insurance Corporation in 1933. Registered financial consultant Meyer emphasizes that banks really pay insurance premiums in order to acquire this coverage. Hence, there is no involvement of government cash in this process. The inability of the financial institutions concerned to fulfill their responsibilities, which may include those to depositors or to other financial institutions, is the primary reason of failed financial institutions, including banks. On the other hand, this incapacity to preserve solvency can be the result of a variety of distinct precipitating events. According to Meyer, this could be a cause of the failure if a bank assumed too much risk in its investments or loan portfolio and then realized its losses. The authorities will presume that the institution will have to be sold or liquidated if additional capital is not raised and if the losses are severe enough. Because banks pay for their own insurance policies out of their own funds, taxpayers are not responsible for covering any losses incurred by financial institutions that take on more risk than they are able to manage. When you get reimbursed for your money up to the maximum, you essentially do not have to worry about being paid back with your own money in the form of taxes because you are getting reimbursed for that money. Bottom line, if you retain your money in an institution that is FDIC insured, then your money is safe at least up to a maximum of $0.25 million in accounts held at the failing institution. This is the general rule. You are assured of the sum of $0.25 million, and in the event that the bank is acquired, even sums that are in excess of the maximum may be transferred easily to the new bank. If there are some other reasons you know, then tell us in the comments, and make sure to subscribe to our channel before leaving.